It's important to me that this channel, Unrivaled Investing, aims to be a beacon of truth. And so when I make a mistake or I just flat out whiff on something, it's important for me to update you with what I've learned. Today we're talking about inflation and what it means both in the short term and the long term for businesses like PayPal and Facebook and what I've learned. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. This is a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice, and at the time of this video publication, I did own stock in Facebook/Meta, but not yet PayPal. I'm still looking at PayPal stock though. So I did a previous video talking about how PayPal is a potential inflation hedge, talking about being a potential money printer. And this still makes sense to me because as there's more money in the system, more money going across their platform, they should benefit by getting a larger cut. And their business model is predicated on the idea of getting a percentage fee. Facebook has a similar business model, except it's effectively merchants or businesses saying, hey, we have more money that we want to spend on advertising. So Facebook gets a larger cut over time as advertising budgets increase with the general economy. Yet, despite these factors, both PayPal and Facebook have declined, and they've called out inflation as something that's hurt their business. So while I thought inflation would benefit both of them, in the short term, it's hurting their business. Let's understand this in greater detail. So PayPal talks about exogenous factors also did impact our results. Supply chain issues disproportionately impacted our cross-border volumes and our small business merchants. Okay, this makes sense. If you don't have inventory to sell, it's harder to have a transaction that goes across the PayPal platform. Okay. Inflationary pressures impacted spending within certain segments of our user base. So that's that inflationary pressure, which I thought would actually be a net benefit to the company. Same thing with Facebook. We've also heard from advertisers about other macro trends that contributed to the headwinds in the fourth quarter, including global supply chain disruptions, labor shortages, and inflationary pressures. Interesting. So here it is. While I had previously called out how inflation would be a net beneficiary, these companies would be net beneficiaries of inflation over a multi-year perspective, in the short term, their results are getting hurt. They're calling them inflation as a direct headwind in the fourth quarter 2021. So why is that? Really, a couple of key components. One is real average hourly income has actually been declining this past year. And so to understand what that means you have your salary. Your salary will go up in a nominal basis, whatever it is, goes up 5%. But if inflation goes up 10%, your real income actually declined by about 5%. And that's what you're seeing here is that real salaries aren't keeping up. The nominal salaries aren't keeping up with inflation. Inflation is outpacing the raises that you're seeing with salaries. Another key aspect on why inflation is hurting these businesses in the short term is because of necessities. As the price of necessities has gone up, things like food, housing, and gas, and keep in mind, I've called this out before, I think they're incorrectly measuring the housing prices, so they're so artificially suppressing it lower, so arguably inflation's even higher. So shoppers have had even less money to buy the discretionary goods that they might buy through Facebook. You might see a widget spinner say, I'm going to buy that. I always wanted that. Oh, but you know what? I just don't have any money in my account because, I have higher rent or I have higher gas payment just to get to and from, or my food costs more. And so when you start factoring these things in, that starts creating real problems for the discretionary purchases that you might have done from seeing an advertisement on Facebook and paid using PayPal network. Now, long term, as real wages catch up, I still believe that PayPal and Facebook could continue to have these toll booth-like financial positions. Effectively, more money in circulation, more money in the system. PayPal gets a cut, more transactions that go across their platform as advertisers have bigger advertising budgets just because, inflation goes up over time. They have more money to spend on their advertising budget. Then what you're looking at, as I would argue, both PayPal and Facebook could benefit long term with inflation. But in the short term, they're hurt because of these very factors that I just called out, effectively saying people's real incomes aren't keeping up with the cost of their expenses. And the necessities are really crowding out these discretionary purchases that they previously would have done through Facebook and PayPal. And so what's the playbook from here as you consider both Facebook and PayPal stock. First, a quick plug where if you're interested in joining a community of fellow investors looking to learn and find exceptional companies for both good and bad times, we have an exclusive community on Discord. You can sign up at unrivaledinvesting.com, click join the journey. I also call out potential multi-baggers and share my own personal portfolio for those interested. Once again, that's unrivaledinvesting.com, click join the journey. And if you enjoy videos like this, please make a point of hitting that thumbs up, hit that subscribe button. And so what's the playbook to consider? I'd say there's really two key points that you want to consider. One is valuation for these businesses, and the other is the sensitivity to real economic growth. And so previously, these businesses, you just look at them and you say, wow, these businesses just grow each year. They demand a premium valuation. And so here it is, the stocks have gone down significantly. And so normally people are like, wow, this is near record low valuations. This is really compelling. But I'd argue there's a component to the recent weakness in valuations that you're seeing with PayPal and Facebook, which is it's now reflecting that these businesses have gotten so big that they're becoming increasingly sensitive to economic cyclicality. So as you have a business that won't necessarily grow throughout a full economic cycle, if you have a business that's like, hey, it's 2008, the world's falling apart, and I'm still growing, that warrants a higher valuation. But if you have a business that's, oh crap, consumers are spending less on my platform because of inflation, because the consumer sentiment's falling apart, because they just don't have the money, then you might warrant having a lower valuation. So it is something to keep in mind as you look at these companies. From a playbook perspective, I would say, okay, so considering this, I'd really want to wait for an even lower valuation multiple. Now, I'm not talking specifically about PayPal or Facebook here. You have to look at each company separately. But when you're looking at businesses that all of a sudden you start saying, hey, they're more sensitive to cyclicality, you want to say to yourself, okay, I want to make sure I'm getting a dirt cheap valuation. It could go, these multiples can go even lower than what I previously expected. And you start considering, oh, this valuation's getting hit because of a short-term impact. And I love opportunities where a short-term impact is hurting the valuation because I still believe that long-term could drive the business. Now, long-term for both PayPal and Facebook are two very different risks, I'd argue. With Facebook, it's more a question of, hey, will there still be a lot of users, a lot of those high-valued North American users on the various different Facebook platforms, in the years ahead? Will they still be there 5 to 10 years from now? Or will people just say, you know what, I've outgrown it, grandpa died, they're no longer on it. You start having that type of aspect where it's like, no one's really using it. Instead, I'm using this Chinese app TikTok or something like that, which just strikes me as completely bananas. And so I say it's bananas just because it doesn't make any sense that Facebook apps are banned in China, but we allow TikTok in the US. That doesn't make any sense to me. But that does, I'd argue, create a long-term risk for Facebook. The same question, I'd argue, is applying to PayPal, where here it is, you're seeing the growth of a lot of various different payment gateways. Will PayPal continue to have their share? Will they continue to take share, or will they lose share to other players? Arguably, you've seen a little bit of that recently as other players have been growing much faster than they have. So they both have longer term risks, but they also both benefit from long-term inflation. So anywho, those are the components that I'd consider. The real takeaway is that both of these businesses are more sensitive to the downsides of cyclicality of the economy than they previously were because they're much bigger now. Hence, I'd argue you're also going to see that when ultimately they bottom, and no one knows when these companies officially bottom, but I'd argue you'll see a lower multiple than you'd expect because of that sensitivity. Just something to keep in mind. If this video has been helpful, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for tuning in.